All right, the Russell 2000 has been on a tear, and it continued. In fact, we've had a good strong 5-day rally here. We've kind of seen some moves on the Russell that we don't see very often in the last 5 days. So I'm going to break those down. I'm also going to break down something that's very unique about this move on the Russell, and that is the fact that the Qs have not participated, which has been blowing everything away. So we're going to take a look at this move in that context to try to determine just how bullish the Russell is with this extreme breakout move. And you'll see how extreme it is here with some of the charts I'll show you. But just how bullish and why is it so bullish? Why has it gone up so much? And is that telling to us in terms of how bullish the broader market will be in terms of like the S&P and the Dow and even today, the big divergence between the Russell and the NASDAQ 100. So we're going to break all that down. Some interesting sector moves, which are not surprising, into some of these areas that kind of support this idea about whether or not the Russell is strong enough to now be a trending move for the broader market, or whether it was just an extreme kind of blow-off move. So we're going to see how that relates to the sector rotation. And then we're also going to take a look at a trade idea for a stock that has been kind of up and down itself, and talk about how to trade, maybe its declining volatility and bandwidth. So let's go ahead and get started. Today is Wednesday, June the 7th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these things on the right, including our Market Outlook live video there. Come down here to the bottom, click this heart. It opens up this tab. Hit that like button. Same thing here. Click on the thumbs up icon there. It takes you to another new tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers. Again, we're in that low 90s, and our goal is always get to 100. So for those who like us day after day, thank you very much for liking the videos. Like I said, it's a big deal for us. That's why we always ask for it. For those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. So after just a really good, strong end of the week last week, that ended with the cluster, the S&P has been flat, but that's good. Like it's, you got your near-term, your momentum line down, but did not get to extreme lows. It's in the oversold zone. It's pretty deeply in there, but not extreme lows. The near-term line's down out of bullish territory, so you're dropping potentially the bearish territory. We'll see what ends up happening tomorrow. But that's not very much of a drop. I mean, look at the last near-term drop into bearish territory. We ended up with a bull tag, and in fact, every single near-term decline here has ended up with a bull tag. And this one's nowhere near a bull tag, right? We'd have to have, again, you have to have the intermediate line dropping below 80, which gives you the pink shading, and then you have to drop below the moving average, and you're 2.5% above the moving average right now. So it would take a pretty significant move. And if you saw, Ryan Dietrich just tweeted this out, that Thursday and Fridays are the 2 best days of the year by far. Wednesdays, Tuesdays tend to be pretty weak. Mondays are positive, but not nearly as much. But Thursdays and then Fridays, in fact, what he says here, that's the best annualized return for any given day ever, for any Friday ever. So, and a really good Thursday too, the strongest since 1951. So, and we have been getting some pretty strong. I mean, that was a Thursday and a Friday move right there. This tag was a Friday move there. This was a Wednesday, Thursday, Friday move. Over here was a Thursday, Friday rally that we had. This one was a Friday rally. That was just a Friday rally. So we've had some good, strong moves over the course of the end of weeks here. Your intermediate posture is above 90 again, just like it was here at the start of the intermediate run that we're on right now. It got above 90. Market sentiment lines now almost in the upper reversal zone. You just maybe a day or two away from you're at 78th percentile and then of course you're getting a short term. This would technically be a bullish intermediate confirmation signal. The intermediate posture is strongly bullish, combined with an oversold momentum line, combined with the near-term line that dipped below 50. All of that sets you up for a pretty good bounce trade. That's what the signal would suggest, right? No signal's 100%, but the signal would suggest that you're due for a strong Thursday and Friday here, based off of the weakness we've seen these first 3 days of the week. Your Dow Jones Industrial Average looks pretty similar. It did have a little bit more of an update today. I remember it's been less bullish here. It actually got an oversold cluster. The intermediate line is above the 50th percentile, but not in bullish territory yet. Your near-term line is not very strong. It never did get in the reversal zone for very long. So, we need to have some more strength if we're going to get the intermediate line to get, because again, what we want to avoid is a intermediate peak that's in the bearish bullish territory, but not in the upper reversal zone, right? The Russell 2000 was looking like we were going to get that, but then now has turned back around and is. In fact, we came within 2 points at 78th percentile on the momentum line. That's how close we came to getting a cluster on the Russell 2000. The Russell 2000, which has been so bearish this whole time, has finally kind of broken up and caught up here to some of these Fibonacci levels. This is the 38% Fibonacci level right here of the correction. All the other indexes, the Dow, the S&P, the NASDAQ, are all sitting at the 62%. So there's the 50% retracement way up here above 2000. So we've got a long ways to go, but you are at a level of resistance. The 62% retracement of this decline, this intermediate decline from last August to mid-October. And then 38% retracement of the post-COVID rally that we had been below and then have now bounced back up. Now we look at the NASDAQ 100, and it's not only did it not have, has it been sideways since it got that cluster on Friday, but today it was down nearly 2%, which is not common for the NASDAQ to be down 2% on the same day that the Russell 2000 up 2%. In fact, this is one of your biggest declines on the NASDAQ 100 in a single day in quite a while. If you look at the Qs, you have to go back over here to April the 25th, so more than a month ago. Then you go back to March, early March, we're looking at about 3 months. So big move higher. And again, if you look at April 25th, for an example, for context here, April 25th is right here, right there. The Russell 2000 was down more than 2%. So again, and then March 9th, which would be right here, the Russell 2000 was down nearly 3%. So on all these other days that the Qs were down big, the Russell was down big with it. So the fact that, again, the Russell was not only not down, but it was up 2% is pretty glaring difference. In fact, when you look at the ratio chart here, which has got a strong positive correlation with the S&P 500. That's why it's again, when this thing goes down, it's traditionally not a good sign for the markets, as it's generally positively correlated with this ratio is positively correlated. There's times where it's been negatively correlated coming off of the COVID low or during the COVID drop. The NASDAQ way outperformed the Russell 2000. And then again, during the reopening trade, there was a significant divergence there. You can see during the correction of 2018 going into early 19, there's a little bit of a difference there. So there's times, 2016, there was a correlation that wasn't very strong with the S&P. But for the last 2 years plus, it's been strongly correlated. And you can see for the bulk of the last, how many years is this? 10 years? 10 years is obviously spent a lot more time above zero than below it. In fact, it's spent a lot more time above 50% than not. So it's generally pretty positively correlated. And we've peaked. And I don't have the chart here. Let me bring up the rate of change down here. And then we'll just look at the last 5 days. This is one of the bigger drops, way down here. One of the bigger drops in a 5-day period for the Russell 2000 compared to the Qs. Again, during that 2020 period when things got really volatile. The 5-day moves up and down are really big, and then they've settled down here. You can see a little brief period there in early 2000 or late 2016 when you had a big drop in IWM coming out or going into and coming through the election of 2016, and then of course you can see things taken off, and you can see that we had negative correlation there. So one of the brief times that the Russell 2000 or the Nasdaq, the Russell 2000 led the market higher, and the Qs obviously didn't participate to the same extent. We were coming off of a peak in relative strength to the Qs, not nearly as dramatic as we've seen here, getting up above 2 for multiple days here, a couple of days in the last week. So pretty big drop off of a pretty dramatic peak. Again, you wonder when will that correlate, that positive correlation, bring the S&P down with the ratio, if this persists into more of a decline. As you can see, we're pretty much sitting on the 50-day moving average of that of the relative strength chart right now as it stands, after being way up above the 8-day and way up above the 50-day before that. In fact, you can see here is, if I were to change that PPO to just the how far above the 50-day moving average we were. Again, there it is. That's how far above the 50-day, and like we're almost down below it. So just that quickly, I mean, we were so far up above it, farther than any other period except for the COVID move. There was the only other period we were actually higher than where we're at right now, and then now we're almost negative. And again, getting negative, getting below that, as you can see here on the long-term chart, when this ratio declines. Over here it rallied during that decline because, again, the relative strength was negative. Right now the relative strength is not negative. It's actually one of its stronger levels, and the histogram is starting to roll over. You wonder how much longer this peak is going to last before we get a new downward trend on that long-term PPO. Let's come back over here and take a look at some of these other indexes here. So let's look at the weekly chart. Very strong move there. The Russell 2000 got a kind of a transition candle last week. You got the green arrow last week. Very bullish candle this week, needless to say. Looking at your Dow Jones Industrial Average here. Try that again. A bullish candle, but not nearly as bullish, and not closing up above last week's high. Though it is a bullish candle, a little bit of a reversal, so that's a good sign nonetheless. Your Nasdaq, on the other hand, as of right now, remember we're 2 days away, but this would be one of our first lower highs that we've had in a few weeks, with the PPO, the Heikin-Ashi differential, the size of the candle getting below its moving average, which this was the last time it was we didn't go negative here, so we never did get red. But generally, when you get below that moving average, it generally leads to, at best, this scenario. And obviously, at worst, something different. But especially with the purple line as high as it is relative to where it's been before. So it's interesting that your Nasdaq is now the one that's showing signs of weakness at the same time that your Russell 2000 is actually showing some strength. I mean, look at the Russell 2000 here. I mean, that's the lowest level that the negative indicator has been since over here in February, and then over here again, and a little bit there in August. This is the highest that the positive indicator has been since this peak in February, the exhaustion peak in February, and then the August peak. So we've gotten this high before, not with an ADX that's this low, but we've gotten this high before on the positive indicator. And when you look at the short-term version of this chart, so you cut the time frame in half here, and you look at the short-term version, it's extreme. Like we got down to 10 on the negative indicator and above 45 on the positive. Again, we've done this before on the exhaustion peak, and we did it over here on the August peak there. So and IWM, if you look at Russell 2000 came close to a cluster. IWM actually did get the cluster, so the momentum line got to 80.5. So you did get the cluster there. You didn't get a cluster any of these other times, though. It's the same kind of idea there, and especially again with a 7.5% 5-day return, which is so extreme. Let's look at the RSI and the CCI. The S&P is still at bullish levels, not very strong, but at least bullish levels. Your NASDAQ is coming out of extreme bullish levels. Your Russell 2000, again, it doesn't get above 200 very often on the CCI, and the last time it did was February 2nd at the beginning of this bullish move there in the early part of the year, and then of course over here in October, and then at the beginning of that August move that culminated with the RSI being as high as it was. So the little different story there, because the NASDAQ really coming down at the same time that the Russell is rising there. Let's take a look at the let's see, the Ichimoku cloud. S&P, you got an intermediate trend strength going there. The Qs, you still have a very mature trend strength. IWM, you're finally above that intermediate trend strength, so it's caught up that quickly. The diamonds never has. There's still no trend on the diamonds, but IWM has broken out to an intermediate trend strength above 2, above 65. First time in a while since that move that led to the February 2nd peak. Well above the cloud. We went from being below the cloud to way above the cloud in 5 days. We went from a negative 26-day rate of change to one of your strongest positive 26-day rate of changes we've seen in a while. Again, that's how big and strong this move has been here lately. The Bollinger Bands, you are still in the upper quartile of the S&P's Bollinger Bandwidth. The bands are still outside of the Keltner channels, as you now have moved inside. The price itself has moved inside the Keltner. That momentum line, you can see what it's doing there. The Qs, which have been so far above the Keltner channel, has dropped out of the upper quartile of the bandwidth and now inside the Keltner channel. So big difference there. Again, on the same day, the IWM, again, this is 3 of the last 4 days, the IWM has blown away the upper band. I mean, this is like something you do maybe in 1 day, but we have blown away that upper band there, and you are way up above the Keltner channel on the first day with the green dot, with the bands breaking outside the Keltner channels themselves. So big blowout move, again, very similar to what we saw in February 2nd in terms of getting outside the Keltner channel, though we were inside the bandwidth at the time. Over here you can see it's kind of similar right now to maybe what we saw there in January, where we got outside the Keltner channels and 1 day outside the bandwidth with the green dot showing up. So we're kind of at that point where we could be starting a really good trend on IWM, though it appears likely that it's mainly just a big blow off type move, kind of like the Russell 2000 had during the meme stock era, when some of the meme stocks would go haywire and kind of do their own thing. Let's take a look at today's range and the Arun indicator here on the S&P. Look how tenuous this S&P move is. Like, we are that, like, if we break through this today's low, yesterday's low, if we break through this area, then this gap is it's very susceptible to being filled in. Remember, the Qs have already filled in that gap easily, has already filled in that gap and then some. And again, it's similar. It's down to last week's low point already, so it's kind of susceptible to that. The Dow has not filled in its gap from last Friday. It's still holding up pretty strong there as of right now. IWM is blown away the move. Like, last Friday's gap is way into the lower half of the chart. The point of control is still down there, but you can see we are way up above the value area the past 4 weeks. So big fast move again makes it susceptible to these, especially with the common gap today, makes it susceptible to these moves because there's not a whole lot of volume down here because you moved up so far so fast to an extreme level in such a short amount of time, to the point where your channel width has gotten pretty big. I mean, 8.5% is a much higher channel width than what you're seeing. Like, it's almost double what you're seeing on the S&P, the S&P 500. Oops, and the Qs you can see is up to a 10% width. So, and it has been bullish for quite a while. and now you can kind of watch to see, you know, how much longer. You know, like if we break through this down here, the low is just going to keep moving up, at least to this point, eventually at some point, and then you see the, you know, the 62% retracement of the correction at this level, getting back below last week's low point would be a very significant move on the Qs to the downside. So, and we're sitting on it now, so it's something to watch over these next couple of days if there's any deviation from the norm in terms of how bullish those next 2 days are. The VIX ended up way down, well below or easily below 14, not well below 14, but easily below 14. The VIX ratio is down to low levels as well, got down to 81%. Remember, 80% is extreme to the downside. You can kind of see, again, just how low we are compared to these March and February lows on the VIX itself, but the VVIX is much higher. Even the correlation is still okay. It's still there on the short term. Here's the 60, the quarterly correlation. And if I were to zoom out a little bit here, let's just open it up so you can see it. And let's zoom out for some context on this. Again, it's not very common for the correlation to drop down to 50% on this quarterly basis. Already has earlier this year dropped down to nearly zero on this level, and again, that kind of that leads. You can see here it led to the drop from a very high level, and the second time it led to a bounce from a very low level. Obviously, if you had to guess whether we're peaking or producing a bottom, we don't know, but it's definitely not a peak because we are off of the peak here, and so you'd expect that we'll get some kind of move. You know, again, even with the correlation down to, you know, 55%, which you can see even these kind of drops lead to rallies and back to the normal strong positive correlation there. All right, now let's take a look at what's driving this price action. Again, you can see the Qs up 18% over the last 3 months, now down to 16.25. IWM, which is down 8%, is now up, or at least is now at least flat. It looks like it's right around just underneath the you know what, just underneath the zero break even there for the past 3 months. Let's take a look at the last 5 days though. Just these last, you know, where it's just been so insane, insanely bullish. So 1, 2, 3, 4, 5. So we'll go to the Thursday. There's IWM. There's a big rally, almost 8%. Was up 8% at one point at the highs of the day today. Up 8%. Of course, the bond yields were up today quite a bit too. We'll take a look at here in just a second. But bonds themselves are down 2%. Look at the Qs. The Qs were doing pretty well too. Emerging markets were doing pretty well. Commodities are doing pretty well. They've all gone flat at best, right? The Qs have dropped today, but they've all gone flat at best. IWM is like, nope. Oh, look at the last 2 days. In fact, if you look at just the last 2 days for the Russell, I mean, these are a couple of big days in a row here, up 4.25%. Real estate up 3%. The S&P, the Q's down nearly 2%. So it's a huge divergence. But so is like gold and bonds are down big here in the last 2 days too. I did want to take a look. I forgot to show you this earlier. That's why it reminded me of it. Here is the 2-day chain. And we have looked at this earlier before for the Russell 2000. We've had kind of two consecutive periods here because we looked at it before over there. So now it's 2 consecutive periods of 4.5% gains. Like, that doesn't happen. Like, you can see that big peak led to a 2-day decline. This big peak led to a 2-day declines. This big peak over here led to 2-day declines. It's not common for there not to be 2-day declines. And not only that, but then rebound up to another 4+% move again in just 2 days. Not very common at all. So, you know, again, that just goes to show just what kind of rally this has been for the Russell over the last couple of days. But as you saw, bonds are down quite a bit today, or have been down, especially over the last 5 days. But look at the move here, back below the 8-day moving average, back The 8-day still below the 17. The MACD and stochastics are rolling over from what would be bearish levels. So bonds are looking to retest the recent lows right around 100, right around par for this particular ETF that we've seen for pretty much most of the calendar year so far, after coming down from the highs, coming down from the point of control and the Fibonacci retracement level of this drop that we've had on bonds. That's the daily chart. Here's the weekly chart. Again, you can see the 8 and 17 week moving averages back below the 30-week moving average, crossing back down. But again, I don't expect that we'll get too much further down. And again, we are a lot more susceptible to a big move up on bonds with how big the gap between the 50 and 200 week moving averages are than we are to a big move down. Like, here's your biggest, I mean, look, if you look at that MACD, if I go all the way back to as far as history that this ETF has, that was the biggest momentum move. You get this big of a move, and again, we've had two. Like, the first one was big enough. We had another one that was, you could argue it's pretty equal lows, but obviously much lower lows there. But you see, you don't really retest these big extreme lows like that, and I don't expect they'll retest it again. So I expect we'll continue to grind in this area before we rally again. Like, bull markets and equities don't start with long-term bonds that are currently that far below the 200-day moving average, for an example. I mean, if you go look at just how far it is below the 200-week moving average, sorry, not 200-day, but 200-week moving average. Again, we're still more than 26% below, which is the lowest of this in the history of this ETF. So I mean, that's a low level. Coming off of what was a pretty high level, we were 32% above it. We have seen that a few times because the markets. I mean, COVID. That was COVID. This was the credit crisis in 2012 that led to QE3, and then of course the financial crisis. So there have been times where it's been that bullish. There hasn't been that time where it's been this bearish, and this has been the first time, of course, of the Fed raising rates. The other time the Fed raised rates was here in 04 to 06, and you can see the bearishness. We did get slightly below the 200-week moving average there by the time it started, right around just a few percentage points. So again, we were bearish, and there's been other times we've been below it, just not to this extreme. The other, pretty much the lowest time it was before this was the the low point of 2018, when we ended up there at the low of October. We ended up with a correction. After bonds went to a slight bear market there, equities corrected down to their 200-week moving average as bonds started to move back up, and then they actually both went up until the COVID drop, where bonds spiked, has been coming down ever since. Gold, another safety trade, you can see appears to be peaking here and has been showing some signs of weakness, getting back below the 17-week moving average. Let's take a look at it on the regular chart here. Back below the 50-day moving average, below the point of control, showing bearishness there. And then looking at the weekly chart, you can see, the weekly chart here, you can see again the MACD is below its moving average as we get below the 17-day. Of course, that's kind of the opposite of what we're seeing on the dollar, as the dollar rallies back up with the move higher in yields, right? As yields move back up to the upside, that's going to bring the dollar up. That's been a recipe for bearishness in the past. We'll see if that persists. If you look at the FOMC here, the odds of a rate hike were in the low 20s going into today. Has moved up into the 30s. Still low probability, but you notice here by July you're looking at about a 68% probability of being at 5.5%. Then you look at December. If we are going to get the 5.5% either at the next meeting or the one after, December, a month ago, there was a 99% chance, 99.9% chance that we would have there's a 100% chance that we'd have a rate cut. There was a 99% chance we'd have 2 rate cuts from this 5.5%. There was a 97% chance we'd have 3 rate cuts from the 5.5%. And of course, you can see 75%-ish of being a full percentage point. That's changed. As you can see now, if we do end up at 5.5% here, you have about a 25% chance of not getting a rate cut, where it was perfect. It was 0 a month ago. It was 20% yesterday. Now it's up to 25%. So it's actually growing that we're not going to get a rate cut by the end of the year, which I think personally is the best case scenario. Really, because again, a rate cut starts to bring this yield curve inversion up, this inverted yield curve back up to the upside. And as we've seen before, well, here it's better to see it here on this chart. As we've seen before, when this has gone back up is during recessions, right? You get recessions as it rises back up, and so we don't want it to rise back up. We want it to stay, and it doesn't stay inverted for very long, unfortunately. But as it starts to rally, that tends to coincide with, again, weakness in the markets and general risk aversion. All right, before we look at our trade idea of the day, let's take a look at the sector. Remember how these were down here at the bottom, had been all dark pink shading and a red line, and then everything up here was so bullish. Well, now you can see some red candles starting to show up, still dark green shading and a green line. But look at industrials, the 5-day move the industrials have had. Look at the 5-day move materials has had. Look at the 5-day rally off the cluster that energy has had. Look at the 5-day move real estate has had, and the 5-day move utilities. And I mean, all of these moves on some of these other cyclical areas that are more associated with the Russell 2000 coming off of very oversold levels. When you look at the comparison chart, again, let's just look at the last 5 days alone. So we'll come to June, and we'll go to the 1st. I mean, look at that. Look at energy and materials. And that's not with the dollar being that weak, but energy, materials, industrials, just blowing things out of the water. Financials up there as well. Real estate joining the party. Consumer discretionary. Remember how we talked about how that had joined kind of that area of the market in its weakness previously. Obviously now has joined it in its strength on the rebound. I mean, they were so oversold. If I were to zoom out now, let's go out here to see when did the Qs really start to take off versus Russell 2000. Let's go to a 1-year chart. And it looks like it was right around this time frame, probably March 6th is when it really, with the banking issues. If you go back to March the 6th, so we're going on 3 months now of when it really started to take off to the upside. Let's go to like an hourly chart here. The Qs and XLC, I mean, you can see even utilities, healthcare did okay initially. Staples was joining, it was doing very, very well as well. They pulled back, both utilities, healthcare, staples have all pulled back. Not the Qs and XLK, they continued higher. XLY has kind of been up there too. But look at how going into June the 1st, when this whole 5-day move started, that's how oversold they were. And so it's not surprising to see industrials, financials, materials, and energy bounce up a little bit and still all be at negative levels relative to where they were when their weakness started, right? When the relative strength really took for the Qs, really took off, and then ultimately, like I said, peaked right here on that May 31st is where it kind of peaked. June 1st, a small little bump before just really diving, especially the last 2 days. The last 2 days, if I were to zoom out back on this and just look at the last 2 days here, 6.6 to 6.7. Again, you can kind of see energy, real estate, industrials, materials, financials just really killing it in the 2-day period. XLK and XLC are down along with healthcare and staples. So again, pretty dramatic reversal, but as of right now, it's just, in my opinion, just an extremely oversold technical bounce in areas that were extremely oversold relative to the big dominant areas there. But so far, as of right now, up to and kind of catching up a little bit on the charts to where some of the other indexes are, but still hitting some pretty significant resistance there. All right, quickly, another way to see that rotation here is on the relative rotation graph, the 1-year graph. You can see XLK, XLY, XLC still have the highest momentum and the highest relative strength. Staples, utilities, healthcare going down, energy, financials, industrial materials going up, but still have the lowest momentum. They were just that, their relative strengths were that poor on a weekly chart. Here's what it looks like on the daily. Really kind of taken off with the highest momentum, which is not surprising. Energy now has the highest momentum. You still have discretionary and technology, which have high momentum as well. And then communication services, and those two have the highest relative strength. But again, look how oversold, and look at utilities and staples and healthcare moving up along with real estate. So you're getting a move into cyclical areas, into value areas per se, but they're also being joined not by other cyclical areas which are losing momentum, but by safety trades which are starting to gain momentum there. So again, that's why I don't think necessarily this is kind of a broad risk appetite type move. I think it's just an oversold technical move as the market moves out of what's been working for so long and it's been so dramatic in the Qs, shifting into these value areas as well as the safety areas. All right, so for our trade idea of the day, I wanted to take a look at Walmart. Walmart has been bearish. Has been trending higher. Had a pullback, which is not surprising. You're going to get a pullback, obviously, every once in a while. Doesn't seem so in some markets, but you will. And then you can see now it appears the pullback may be done as the intermediate line is pulled out of the bearish territory, and you can see that we're almost about to cross above the moving average there. When you take a look at this chart, you can see again we had a red arrow 2 weeks ago. We're back to a green arrow, so back above the 2-week moving average and getting a reversal, kind of at least a transition, at the very least a transition candle this week, with the Hakunashi differential getting above its moving average and above zero. So a good sign there. When you look at the 3 green arrow chart, you can see that we do have the MACD is green, the MACD is above its moving average, stochastics is rising. You're flirting with the moving average. So you got 2 red arrows, but it doesn't look like it's like they're about ready to explode to the upside. The RSI and the CCI are both at neutral levels. They're not bearish. They're bullish, but they're not like strongly bullish. They're bullish enough to not be bearish anymore. Your DMI shows a very similar pattern, both positive and negative. Your positive's above the negative, but again, it's not above like 30. You've been strongly bullish, and now you're kind of more neutral. That's also showing up in your Bollinger Band width. As you can see, you're in the middle of a declining band width that is actually outside of its Keltner channels. That looks like it's about to move back inside of its Keltner channels and start getting some red arrows there. So that opens us up for a sideways trade, a iron condor spread, selling the 25 delta, the mid 20 deltas there, or at least try to get to the low 20s. You just don't have a lot of options here because it's $5 wide spreads. So sell those, buy one strike away for protection. You can see that sets us up there, and then our break evens are the blue lines on the charts outside of the Bollinger Band width. When you look at it on this chart here, pull up Walmart and you can see where the break evens are. So again, you've got strong support below the lower break even, and you've got multiple highs up here below the upper break even. So I mean, if it's going to break out to the upside, you're going to be taken off. That's unlikely, right? If you're break down to the downside, you've got moving average, the 200-day moving average, which has held for support lately, as well as the point of control, a big volume node there. So that will limit any major downside moves. So that sets us up for that type of a trade, this iron condor spread. All right, well, that is it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Follow and like us on Twitter and Facebook as well. Join our website at marketscholars.com for free. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.